got Mr. Kamlesh Gandhi, Chairman and Managing Director of Mars Financial Services, Mrs. Darshana Pandya, Director and CEO of Mars Financial Services, and Mr. Ankit Jain and other senior management team from Mars Financial Services to take us through the first quarter FY24 earnings. Over to you, sir. Thanks.
So thank you, Subhranshu, and good evening to all of you, and I'm very happy to welcome you all of you to this earnings call. I'm very happy to report a very robust quarter for the company. I shared with all of you through our presentation and press release. We had a very strong growth of 25% plus, and to be precise, 26.23% on a consolidated basis on AUM, and around 25.38% on profit after taxes. So friends, this is our 113th quarter of a very consistent and a robust growth, backed up by very strong fundamentals as far as asset quality is concerned and capital adequacy is concerned. If I talk about asset quality, we are at around less than 1.5% on our net stage 3 asset as I talk to you, and with a very strong capital adequacy of more than 25%, making us more confident and giving us enough room for a sustained growth going forward. We're very happy to share that we have strengthened our distribution also. In terms of distribution, we are now close to potentially 10,000 centers in our reach, along with our partnership with more than 150 NBFCs of the country. This makes us gives us a pan-India presence, but with a very effective and efficient distribution, which is evident from the asset growth accompanied by the asset quality also. In our housing finance, the subsidiary of the parent group, that company also grew very strongly. We registered a close to 32% growth in AUM. Currently at a smaller AUM of around 450 crores, is well poised to touch 1,000 crores within the next 2 years, and will start contributing very meaningfully to the overall growth of the company. In our housing finance company, we are also very well placed as far as capital adequacy is concerned, of close to 40%. And once again, the next stage 3 assets there is around 0.52%. So overall, a very strong growth for the quarter accompanied by very strong asset quality and a strong profitability, and with a strong fundamental of a very strong capital base. If I take you through a few other important aspects during the quarter, we are now 2,900 people team, along with our housing finance company, and we are increasing, and we are a very strong team which is contributing very meaningfully and which is contributing very efficiently to the overall growth of the company. In terms of digitization, we are well aware of the necessity of digitization, and we are continuously in process of digitizing our processes, be it our loan origination system, loan management system, and we are also moving towards our BRE project, whereby it will add us on credit decisioning. And all these things is added by our services through various APIs and account aggregators, which numbers more than 25 to 27 in number. So all in all, a very strong quarter, and as we have demonstrated over 6 quarters now, post-COVID, a continuous growth of 20-25% plus, while maintaining a very, very strong balance sheet and very strong asset quality. We are very confident that going forward we'll be in a position to maintain this growth. And as far as this year is concerned, we are going to cross we are poised to cross a very important milestone of crossing 10,000 crores maybe by Q3 or Q4. That will be a very important milestone in the journey of this company, and I think we are a striking distance away from it. So with this remarks, I will hand over. With this remarks, I will hand over to my colleague Darshana, who will take you through the detailing of the numbers, while numbers are before you, and also my colleague Ankit Jain, who will take you through the liability management. As you know that we are one of the strongest liability management with sufficient liquidity always available with us, and with some capabilities to raise the liability at will, and demonstrated our capabilities to raise at a competitive rate throughout last year. And with the increase in MCLR, we also saw a rise in the rate, which will be elaborated by Ankit in detail. But nonetheless, we could maintain our needs and the ROA. So with this remark, I will pass on this to Vaishnavan to take it forward to take you on the detailing on numbers.
Thank you, sir. Good evening, everyone. I'm happy once again to connect to all of you. As sir mentioned that we had completed the last year with robust numbers, and we continue to move ahead in Q1 FY22 also. So if we look at the AUM, as on 30th June, we stand at around 8,417 crores as compared to 6,683 crores, which is 25.94% growth in AUM. And if you look at the configuration, around 12% portfolio share is from our wheels product, two-wheeler and commercial vehicle. 84% is MSME loans and 4% is now salaried personal loan. And if we look at the growth numbers for each product, MEL loan has grown by 16.14% from 3,462 to 4,021 crores. SME loan, there is a growth of 25.85% from 2,443 crores to 3,074 crores. Two-wheeler loan has shown robust growth of 47.73% from 386 crores to 570 crores. Commercial vehicle loan has grown by 34.87% from 332 crores to 448 crores. And salaried personal loan it was introduced during the last June 22 quarter. So the portfolio as on June 23 is 302 crores and last year it was 59 crores. If we look at the profitability numbers, total income has grown by 41.60% as compared to Q1 23. Which is 280 crores from 197 crores. Profit before tax has grown by 22.83% from 61.71 crores to 75.80 crores. Profit after tax has also grown by 24.16% from 46 crores to 57 crores. Portfolio quality also remains stable, which last year it was 2.15% gross stage 3 and net stage 3 was 1.52%. This year it is 2.13% gross stage 3 and net stage 3 is 1.47%. And we continue to carry a management overlay of around 21 crore 46 lakhs as on 30th June 23. Now coming to our housing numbers. Here also we can see the robust growth. So asset under management portfolio has grown by 31.91% from 341 crore to 450 crores. Total income, there is a growth of 55.08% from 8 crore 78 lakhs to 13 crore 61 lakhs. PBT increased by 51.97% from 1 crore 33 lakhs to 2 crore 2 lakhs. Profit after tax, there is an increment of 57.97% from 1 crore to 1 crore 60 lakhs round. If we look at the quality here also, we could maintain the quality of the portfolio. So as on June 23, our stage 3 asset is 0.71% and net stage 3 is 0.50% as compared to 0.70 and 0.52 respectively in the previous period. Here also, we are maintaining around 3 crore 12 lakhs of management overlay as a buffer. So this was all about the key numbers. Now I'll request Ankit to take you through the liability management.
Yeah, thank you, ma'am. So to further elaborate on the liability management, we through the efficient liability management was able to maintain average cash and cash equivalents of around rupees 700 crores during the quarter and unutilized cash facility of around 375 crores. In addition, we had sanction on hand to the tune of more than 775 crore in the form of term loan, direct assignment, and co-lending. In the last quarter, company did around rupees 605 crore direct assignment transactions. The company has further more than 500 crore sanction on hand, which we will be utilizing during the next quarter. The company off-book portfolio through DA and co-lending stands at around 21% of the total AUM. We, as a strategy, aim to maintain around 20% to 25% of AUM as off-book through direct assignment and co-lending transactions. The company has available capital facility of around 1690 crore, out of which we maintain an average utilization of 65% to 70%, and this portion is kept as liquidity buffer. We successfully rolled over around 1350 crore as short-term working capital loan, which are sub-limit to the cash flow limit. In the last quarter, we raised around 375 crore term loan, which has further helped us to strengthen the asset liability maturity pattern. We have assessed the structural liquidity for the period, and based on the assessment, there is no negative impact on liquidity, and the cash flow in all the cumulative buckets remain positive. We remain strong on the capital equity, whereby the capital equity for the quarter was 25.31%, with Tier 1 capital of 21.11%, and the debt equity of 3.79 times. And the cost of borrowing for the quarter was at 9.65%. Similarly, for the last June quarter was 8.77%, and March quarter was 9.26%. The increase is majorly because of, as you know, because of the increase in the repo rate and the MCLR trigger reset happening in the current quarter. We envisage that the cost of borrowing to settle around 9.75 to 9.85% in the current year. Thank you.
Thank you, Ankit. And now we are open to take the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumit Rathi from Centrum PMS. Please go ahead.
Hello. Thank you for this opportunity. Sir, a couple of questions. First, I wanted to understand how much of our total book is secured and how much is unsecured, and what kind of collateral do we take in our 85% odd kind of book of SME and micro lending?
So in terms of our MSME portfolio, when we talk about MEL and when we talk about SME, these are the two products where we give working capital loans to the entrepreneurs. We take current assets as hypothecation and it is cash flow-based assessment, and we do not take any other collateral other than the current assets. So in terms of the unsecured portfolio must be around 25% of the total book must be around unsecured, where there is no hypothecation of current assets. Whereas we must be having 75% of secured portfolio comprising of hypothecation of current assets, two-wheelers, commercial vehicles.
Great. So, as compared to historical numbers, I guess it has been a conscious strategy to reduce our dependence on our partners and probably we are working on low leverage. Are there any perspectives you would like to give on a long-term basis how leverage can improve our ROE going forward, or what's our perspective, how much off-book we will like to have? Any colors on that? That would be my last question.
So in terms of distribution, I've been sharing with all of you since few quarters that we are very happy with both the distribution, our direct distribution and our distribution through NBFC. But our direct distribution is increasing at a faster pace as compared to our distribution with NBFCs. So if I give a medium-term view, I think our direct distribution will consist of anywhere between 70 to 75% will be direct distribution, and around 25 to 30% will be distribution through NBFC, as I say it right now. In terms of leverage, we are right now at 3.79 on scale, post 10,000 crores. We see ourselves maintaining anywhere between 4.25 to 4.5 times of debt equity.
Great. Thank you, sir. Thanks for this.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. Participants, to ask a question, you may press star and 1 on your touchtone phones. The next question is from the line of Divyansh Gupta from Latent Advisors. Please go ahead.
Hi, am I audible?
Yes, you are audible, sir.
Yeah, I was looking at the personal loan portfolio. While, let's say, on a year-on-year basis, the personal loan book has grown about 6 times. But on a quarter-on-quarter basis, actually either static or gone down by a couple of million rupees. So can you tell about what happened? Why isn't the book growing on a quarter-on-quarter basis?
So when we start any new product, we don't have a quarter-to-quarter target. It is on a yearly basis. And we see personal loan contributing around 5 to 7% of our total AUM on the yearly basis. And the fluctuation on a quarter-to-quarter is on number of fronts, maybe because of the number of people on street working, the number of rejections versus login, and other factors that might be responsible for a lower disbursement. But we don't focus on a quarter-to-quarter growth as far as our new products are concerned. And as I shared with you, personal loan will constitute around between 5 to 7% going forward.
Got it. Is there any stress that you were seeing in the personal loan portfolio due to which, let's say, a tightening was done for the book or something like that, or just, we are not seeing that stress, but adopting to various credit screens from time to time is a very continuous process depending upon the portfolio analysis we do. And as I said, this being a new product, we will be very cautious on any of the changes we make in our credit screens and any of the changes we see in the portfolio. Got it. And one more question with respect, one request. In the presentation, I could not find the asset liability maturity profile. If I can request you to include it next time, because it also gives a sense of what kind of duration you are borrowing and what is the asset profile looking like. If that can be added, that will be very helpful to understand the...
That can be added, and you can request offline also. Will be provided.
Got it. And one last question I was seeing, let's say, from either on a sequential basis or on a year-on-year basis, your 1 to 30 DPD is actually on a higher AUM book has increased, like from 1.09 to almost 1.91. And on a combined basis also, if I look till 60 DPD, the book has either on a year-on-year basis actually gone up and on a sequential basis almost flat. So anything which is driving, let's say, a higher 1 to 30 DPD for the quarter sequentially?
So, this is Ankit. You have to compare with if you compare with March, because you have to compare from March quarter to June quarter.
Yeah, I'm looking that only. So 1.8 to 1.9.
But you have to see then rather it has improved, because if you see 31 to 16 March quarter was 1.13, which is to 0.86 in this quarter. So rather
there has been some rollback from the higher bucket to the bucket.
Yeah. So therefore, rather it has improved.
Got it. And overall NPAs have reduced. So from which sector or which line of business was there more recovery? If you can give a flavor of that.
So that is major contribution from the majority of the portfolio that we own. That is from micro, small and medium enterprises loans, because that is 82% of our portfolio. So better performance there results into a better quality of assets.
Got it. Yeah, that's all from my side. Thank you and all the best.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital India Private Limited. Please go ahead.
Good afternoon, sir. Sir, if you can please explain the percentage contribution from our NBFC partners and what that accrues in our AUM now, and what is the plan 3 to 5 years from now? What will be the number going forward? Also, if we can speak on the write-offs and which all segments contributed to those write-offs, and how do we look at the micro enterprise lending going forward, and what are the risk control measures we're likely to take in that specific segment, sir? Thanks.
So as I said earlier, our NBFC distribution currently stands at around 37%, which in a medium term, say within next 3 years, we should see that settling anywhere between around 30%. And in long term, it can be anywhere between 25 to 30%. So our NBFC distribution will contribute around 25 to 30% on a 5-year horizon. In terms of our micro enterprise loans, as you say, in our MSME portfolio, we are more focused on SME. While our focus on MEL continues, but SME will contribute more because of the ticket size and the tenure as compared to MEL. So within the configuration of our MSME portfolio, within the medium term, we will see a 70-30 or 60-40 ratio between SME and MEL in favor of SME going forward. And in terms of write-off, I think we'll share the numbers.
Yeah, so total write-off for the period for Q1 is 10 crore 47 lakhs. Out of that, 7 crore 63 lakhs is from MSME. SPL being the new product, there is zero write-off. SME loans is 1 crore 7 lakhs. Two-wheeler is 91 lakhs and SRTO is 86 lakhs.
Understood. And when we look at the salaried personal loans, what kind of companies are we catering to? Are these Cat C, Cat B companies? And what proportion of these loans will be less than, what proportion of this book will be less than 50,000 ticket size?
If you see, average ticket size is around 2 lakhs of rupees, and the companies which we cater to are the ones we do categorize them. So in terms of the parameters of being listed or size, you can call them the B or C category companies. But we are circumspect of the fact that those companies' financial health is good, and moreover, we look into that the employees' credentials in terms of their skill set and in terms of their vintage with the company and their overall experience. These are the basic criteria which we look at while extending the loans to them. And our experience so far over a year has been encouraging to take this portfolio anywhere to around between 5 to 10% of our AUM.
Understood, sir. And how do we look at the vehicle finance portfolio, the CV portfolio? Is it mostly for LCV? What kind of growth are we looking at going forward?
So with economy coming back on track, I think you will agree with me that CV portfolio is directly related to the growth in the economy. So with the economy coming back to normal of around 6% plus growth, I think we will also see a good growth and a good asset quality going forward as far as commercial vehicles are concerned. Because in past few years, we were not finding a good risk-adjusted return as far as commercial vehicle financing was concerned, and hence not much capital was allocated to that. But presuming that this is going to be a consistent growth going forward, I see the commercial vehicle portfolio growing anywhere between 25 to 30% for us.
And what kind of yields do we get in CV financing, sir?
The average yield ranges, depending upon the products and the customer profile, the average yield ranges within 16 to 19%.
Understood, sir. And what will be the average yield in personal loans, sir?
The average yield in personal loan will be around 21%. Will be between 19 to 21%.
Understood, sir. And if we can also speak on the liabilities, sir, what are we looking at in terms of the repricing going forward in the next 2 quarters? What kind of cost are we going to incur in onboarding newer liabilities? How are we looking at the securitization market going forward? So if we can speak on that, sir. Thanks.
See, on the liability side, if I give the configuration, we are well capitalized at around 25%. We would like to assign anywhere between 20 to 25%. We have close to 15 to 20% of cash credit limit. Because of the maturity profile of our assets, we do not find any asset liability mismatch even using cash credit. But it helps us to reduce the cost, converting those cash credit into WCDL limits, whether we get at a lesser rate. And the rest will be around 35 to 40% contribution is from term loans, and around 12 to 15% we see coming from capital markets in terms of bond placement. I think this will be the broader configuration. And as far as we are concerned, we have a lot of traction on assignment transactions, given our portfolio being qualified as priority sector lending and retail lending for the bank. But as a good diversification mix, we like to limit those assignment aspect to around anywhere between 20 to 25%, so as to have the right diversified resource mix. In terms of the borrowing cost, as Ankit shared, we see this has been peaked out maybe in 5-10 basis points here or there. But I think the majority of the MCLR reset has happened for us. And going forward, if we expect a status quo in the repo rates and going forward after good benign situation as far as the macros are concerned, and when the rate starts going down, we can also see some reduction in the rates. But currently we see this cost of funds almost peaking out at current levels.
Understood, sir. Those were my questions. Thanks.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. Participants, you may please press star and 1 if you wish to ask a question. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone. So again, just a continuation of what you answered before this, wherein you suggested that MCLR resets have already happened in majority of your bank term loans. So this cost of borrowing increase from current levels of 9.65 and what Ankit sir guided for 9.75, 9.85. We wanted to understand from where are these going to come from. This will be in the nature of, again, some more MCLR resets that will happen, or this will be more in the nature of some debt capital market borrowings running down and which have to be replaced with higher cost borrowings. That is the first question that I wanted to understand. The other question is, sir, I don't know if I heard you right, but please correct me if I'm wrong. I mean, somewhere I heard that you're guiding that we will be able to maintain our margins. So underlying that, I mean, is the belief that we will be able to kind of continue to take yield increases from here? Is that the thought process to maintain the margins?
So to answer the liability front, I think when we talk about the cost settling at anywhere between 9.65 to 9.85, it will be a combination of reset of rates across all the sources of funds. Maybe the new loans which we take will be at the MCLR, what is already we are taking right now, because there is a rate pause, and I see banks maintaining their MCLR plus whatever premium they want to maintain. So that will stabilize. Our capital market borrowing will also come at a renewed rate as compared to what we had done last year. Further, that MLD the annuity tax benefit is also being withdrawn. So that rate will also be recalibrated to the newer rates. So all the sources of funds will have a recalibrated rates, so to speak, and that will take our borrowing now to anywhere between 9.65 to 9.85% currently, until there is a reset of MCLR or borrowing rates going down. In terms of maintaining our NIMs, yes, we could pass on this rate hike to the borrowers successfully, and we think that this type of rate hike to be passed on to the borrower is possible for us, given the segment where we work in. And we see that our NIM should be maintained anywhere between 6.75 to 7%, and that we demonstrated this quarter also, whereby our NIM settles anywhere at around 6.8% this quarter, despite of the rise. So we'll be in a position to maintain the NIMs for going forward.
Well, it's just one more question here. In the context of so much that is being discussed in terms of this first loss default guarantee, FLDG guidelines up to 5% that has been allowed. So just wanted to understand, two things here. One is in terms of, few digital partners that we've recently started working with, have the commercial arrangements evolved to now factor in these FLDG arrangements? And secondly, sir, when you work with your NBFC partners, I don't want to call it an FLDG, but what are the terms like with regards to when you work with these NBFC partners? Are the risks entirely on your balance sheet, or given that, there is some, at least in terms of digital partners, some FLDG being allowed, then there also, partners have started favorably looking at giving some FLDGs?
The underlying principle working with the partners is that we understand this partnership brings about individual expertise to the fore, whereby the originators will originate service and will bear the delinquencies to a part where they will be shared, and so will be the revenue shared. So in terms of our fintech partnership, where this digital lending, due to digital lending guidelines, where it is limited to 5%, I think if you see last quarter, we had reduced our disbursement to fintech partners, whereby we had more FLDGs because of our loss anticipation. Now with the partners whom we contemplate to work, we are going to have a renewed rates charged to them in order to cover the risk envisaged. So for many of the partners, the rate might increase by 1 or 2%, depending upon the portfolio quality that we have seen or we have witnessed during their working over the past few quarters. So that will put us at an equilibrium in terms of our needs, because whatever more losses may be expected will be recouped from the yields. And in terms of our NBFC partners, where there are yet to be any clear-cut guidelines on non-digital lenders, in terms of our NBFC partners, there are various type of arrangements, from a complete recourse to them to a partial recourse to them, which is then built up in the various type of pricing, thus maintaining our needs the way we would like to maintain.
Got it. So this is very useful. Thank you so much.
Thank you. We have the next question from the line of Anuj Sharma from M3 Investment. Anuj Sharma, the line for you has been unmuted. You may proceed with your question.
Yeah, am I audible?
Yeah.
Hello?
Yeah, you are audible.
Yeah. So maybe I just repeated, I was on mute. So our operating expense ratio have been controlled and partly because of the growth in the AUM. But where do we see it in terms of going ahead when you just benchmark with the loan growth we are seeing? And how optimized it is right now, and where do we see it 3 to 5 years down the line?
So if I understand the question correctly, the operational expenditure has been slightly less because of the denominator impact, as you rightly understood. But as we increase our retail distribution, we see our operating expenditure anywhere between 2 to 2.5%. But how we look at it is that on the overall unit dynamics, on our direct retail distribution, the yields will also improve. So ultimately, our ROAs will be maintained anywhere between 2.75 to 3%. So our focus is to see to that we maintain ROAs between 2.75 to 3%, which is a result of the yields we get, the cost of fund, the operational cost, and the credit cost for each product. So if you see only from the standpoint of operational expenditure, it has the potentiality to settle anywhere between 2 to 2.5%.
All right, that's helpful. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1 at this time. Participants, to ask a question, you may please press star and 1. The next question is from the line of Yash Soni from AK Capital. Please go ahead. Yash Soni, the line for you has been unmuted. Please go ahead with your question. Yash, you are not audible at the moment. As there's no response from the current participant, we will move to the next question, which is from the line of Ojasvi Kisha from PGIM India Mutual Fund. Please go ahead.
If you can guide, what is your guidance for full year FY24 on credit cost? And if I have to look at long-term, given direct distribution mix going up, historically we have seen, credit cost of 1.82% also. So, given, your, higher mix for direct distribution, could it reach, those levels over medium term? Yeah, thanks.
Currently our credit cost has been around 1%. The credit cost for the quarter was around 0.95 to 1%. And once again, as we increase our direct distribution, once again the unit dynamics will come into play. And currently the credit cost, partial of the credit cost is absorbed by the partners to the extent we share the revenue. So when the direct distribution increases, that credit cost will come on the books, but at the same time, our yields is also increase, maintaining our ROAs anywhere between 2.75 to 3%. So what looks like around 1% credit cost on a higher distribution of around 70% might look at around 1.5 to 1.7% of a credit cost. But at the end of the day, the ROAs will be maintained because of the higher yield, which is currently being absorbed by the partners.
Okay, thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
So thank you so much, everyone, for joining this Concall. And let me reiterate the commitment of Team MAS of excellence through endeavors, and we are very confident of going forward to achieve the growth of anywhere between 20 to 25%, which results into doubling our AUM every 3 to 4 years, accompanied by robust asset quality and profitability. Thank you.
Thank you.
Thank you.
On behalf